Hey everybody, it's Larry Berman here. Let's take a dive into the chart room and see what we learned this week. This is what's on my radar. Normally we wouldn't spend so much time on economic data, but really it's economic data is what's shaping the narrative in markets today and of course around inflation. So this week we got a couple of really very, very positive inflation numbers coming out. Now, core inflation is still well above where the Fed would like to see it. And a rate hike is almost a virtual certainty in the US on July 26th. Beyond now that, the odds of additional rate hikes are all going to depend on the go forward in terms of inflation and inflation expectations. The mathematics of seasonality and drop-offs in last year's numbers and favorable comps, as they call it, are okay for the next month or so, but really start to turn against the tide going through the end of the year. Now, a lot in the core is going to depend on housing and rents, and you've got all kinds of mixed opinions on that, but the data on average is going to get a little bit better before it possibly gets a lot worse. And so the market's rejoicing and celebrating. And, so when we look at the economic surprise index, in general, the economic numbers have been better than expected. This is the Citibank US Economic Surprise Index. Let's throw out the extremes of COVID for a minute. But even within the shock of the great financial crisis, we did not see, in terms of good news and surprises, when talk about green shoots and things turning, we didn't see the Citi Surprise Index getting much above where it's sitting today. And so a lot of the good news in terms of the economic surprises, are probably already in the market. When we blow this up, we can see that, okay, banking crisis March, we turned the corner in May, and it's been really positive news ever since. A lot of this is inflation related, to be sure. If we go back to today's numbers, or Friday, sitting here late Friday in the trading day, the UMISH on sentiment numbers came up. Again, people are feeling a little bit more confidence. Jobs are still there. That's the critical thing. When asked about inflation expectations 1 year out, expectations were for a downtick. They actually upticked. When this printed at 10 a.m., top tick the S&P 500 this week. And as we sit here late Friday, we're down a little bit, but not much. Later in July, we got a big rebalancing that's going to put pressure on Apple and Microsoft. That should be a limiting factor. Put the August 2nd date on your calendar. That's when we get the refunding announcement, quarterly refunding announcement in terms of the composition. On the size, we expect on July 31st, 540, 50, 60, 70, 80 billion needed. Composition of that supply is going to be important. If Janet decides to fund most of it with bills, like she did with the refunding of the TGA, then risk assets can keep going. But seasonality wise, if she decides to turn the coupon spigot on and bond yields have to push higher, that's when risk off markets, seasonal August, September, October can trigger. And so that's a big day in August. And we expect, if she keeps things status quo, meaning the percentage of bonds needed versus bills and that mix of them remains to be about 80-20, then we're going to need an awful lot of coupon bonds in the next few months. That means yields need to go higher. So that's a big thing we're focusing on. Earnings started. If you look at some of the names in our portfolio, United Health, great numbers. Obviously, a BlackRock, biggest asset manager in the world. Markets are up this quarter, really good numbers. JP Morgan beat, State Street beat. When we look at JP Morgan's price behavior on Friday, We got the beat, markets gapped open, and it basically they sold into it all day, and they kind of took some money off the table. So when you look at that behavior and you see that, you probably think a lot of good news is priced in on the banking side. We'll see in the coming days, what Goldman Sachs does. They came out this week and said things weren't as good, in fact, for them. So kind of surprising. JP Morgan's, trading revenues and capital markets, investment banking were good, and obviously assets were up overall because markets were firmer, and so that was a plus for the wealth management side. But I like Goldman Sachs here because it's really non-banking. I mean, they do some banking. They were very bad at it. They're exiting that business. This is the pure brokering side and the risk side of things. So I like this. This is a better picture of what's happening than what we saw in JP Morgan that attracted a lot of assets, post bank failures in Q1. So, we had some bearish price action here, which we commented on a few weeks ago, mid-June, started to see the sell-off. We had this double top island reversal we talked about, last week, and then boom, couple positive prints on inflation and new highs. So the pattern of higher highs and higher lows is continuing. We need to see this pattern break for the chart to break. We don't think that's likely until we get the quarterly refunding announcement. So pullbacks are short-term buying opportunities. Don't get me wrong, I'm not bullish here on valuation. I'm just saying if you're a trader, then you can probably now, if we start to see the market close below here and certainly below here on the spiders, that is going to change the picture and the messaging in terms, but I don't think that happens until at least August 2nd and beyond, and when we find out what the impact on long bond yields are going to be. So when we look at 30-year bonds and we look at that chart, we commented last week and in previous weeks about this moving above 4, caught some support. We were buyers into that weakness. But again, pattern of higher highs and higher lows in terms of what's happening to yields. And so this trend is still intact. Which one wins? What is a certainty to me is bond supply is going to be massive and QT impacts for the next year. I think the bond market's going to be right here in the sense that what this rally was about was pricing in a recession. What's still to come is QT and supply, and increased supply needs to push us back up at least till this high. Where were asset markets when we were printing here in October? I don't need to go back and tell you that. Somewhere below 4,000 on the S&P 500, probably not towards those October lows unless the economic hit starts to materialize and we start to see earnings hits and job hits at the same time. We think it's ultimately coming, but maybe it's pushed out a little bit longer. Anyways, that's all we have for you this week. No real bull and bear pick of the week. It's hard for me to get bullish here with markets pushing up the way they have. There's very few pockets of weakness. We've talked in recent weeks about what some of those areas are. Just be cautious here and don't let FOMO be your driving factor, folks. Have a great week, everyone.